under the Tax Reform Act. Currently, a lot of those dollar investments are held in U.S. Treasury securities or in high-grade corporate debt. And when we're talking about the size of the positions of some of these corporations, the liquidation of those investments to repatriate the cash to be able to use at the corporate level for either share buyback or reinvestment could be rather dramatic. It will be like adding a couple of new Treasury auctions to the annual Treasury cycle. Most of that paper is held in longer dated securities, so there could be impacts in terms of the slope of the U.S. interest rate curve. In addition to that, our central bank has, which got very heavily involved in buying long-dated government securities during the crisis, has ceased to reinvest the proceeds from those investments. In other words, they're going to gradually, and they have signaled this to the market, gradually not reinvest those proceeds. So you're also going to have a lack of buying on the longer end of the yield curve. All of these things combined with a central bank that has signaled that it's going to be raising short-term rates will, from a trader's perspective, hopefully reintroduce a higher level of volatility to the market. But it can also be managed and mitigated through the use of a suite of interest rate products up and down the yield curve, as well as listed options on those products. So if you're tracking US dollar interest rates, from a Treasury benchmark standpoint, CME Group's interest rate products, both in Treasuries and commercial-backed other instruments, would be certainly worthy of consideration.
Great. Thank you very much, Mr. David Gibbs, for the overview on interest rates outlook. Now, we'd like to return to the poll we had earlier, because we want to know what is important to everyone here. Now, most of you mentioned the lack of information and risk management are the top concerns in terms of considering trading in global offshore futures. What I'd like to do now is perhaps go around the panel, perhaps starting with our panelists from Hong Kong, to share any success stories you might have in terms of other funds or sophisticated investors who have successfully used global futures, bearing in mind that our audience here cites lack of information and as well as questions on risk management as some of their top concerns. Mr. McAvoy?
Yeah, thanks. I think, a natural example would be if you have exposure to China in your portfolio, and in the case of Hong Kong, you have the Hang Seng Index or maybe the CEI Index, which today China Enterprise Index makes up mostly H shares and a bit of Hong Kong. As we go into this year, Hang Seng Index company will add in P chip and red chip, so it'll reflect a lot more the offshore China market. There are times where you may not want to sell your holdings in a portfolio, but either get, either equitize cash coming in, not sell your holdings. If you have a need to generate cash, you could use futures. You could, hedge, for example, the downside if you think that the market's going to fall. So many times it's looking at what your exposures are in a particular portfolio. In the case of Hong Kong, Hang Seng is an obvious benchmark, and that happens every day. Clients are coming in to either equitize cash or put on a buy a put, or potentially do an overlay because you think it's going to go on the upside. So,
great, thank you. Now I'll invite our panelists from Singapore to provide, share any similar success stories you might have.
Now, in Singapore is a very small market in itself. Majority of our investors actually outside of Singapore or have funds that have origins outside of Singapore. So a lot of our participation also builds on the fact that Singapore is a big fund management center. So it becomes a booking center of sorts for a lot of the funds that are whether equity-based, commodity-based funds, and so on. So we've been beneficiary of that. And when the fund managers take a position on a certain market, they will find that futures is a very cost-efficient way of access. Of course, their mandates have to allow them to get into a leveraged position. And so that will be the first step, to make sure that your mandates allow you to sort of get involved in leveraged derivatives. So that would be the first step. And thereafter, then it's seeking out the right markets and exposure that your view is, that your portfolio managers have a view on. Of course, depending on your view, again, you can take a bearish or a bullish position and be able to manage your risk that way. So we've seen lots of a lot of success or rather successful use of our products in these mandates. So of course, please feel free to reach out, whether outside or later on, we can sort of share some of these with you. Thanks.
Great. Thank you very much, Ms. Chia. So the Thai regulators recently has liberalized the investment of global offshore futures to accredited investors under the hedge fund and private fund scheme. So perhaps that's something that some of our institutional partners might be looking at. Moving on to our panelists from Malaysia, any examples or case studies you'd like to share with us?
Right. Before I go into the case studies, going back to the questions on board, that lack of information and risk management are two areas which the audience here are concerned about, right? And lack of information, and of course, every investor wants to make money, right? And they're just looking for products, avenues, especially products on the best product to go into to generate a sizable return, right? And moving on to risk management, there's always an element of uncertainty. And tying back to the earlier question, which was, I think, quite an interesting question, whereby one of the audience asked a question on what will cause the next financial crisis and so forth. So, and as you can see here, that there's no crystal ball that can actually tell us that what will be the cause of it. But you can look at indicators as an investor. For example, and I think that the world now is a bit complacent. If you look at the world at large, you can see that US rebounding, EU is rebounding, China didn't go into a hard landing with the policies and such. Emerging markets, currencies, they're all recovered. And look at the stock market, it's all-time high everywhere, right? So having this, I think investors are very complacent, but if you look at indicators, you can actually look at the VIX index, for example, right? The VIX index is actually at a low level, actually one of the low levels in 1993. And if you look historically, before every crisis that happens, because when a crisis happens, the VIX index will spike. And before every crisis, the VIX index actually goes to a very low level. And we're now at a very low level. That signifies complacency, because the whole world is green, but at the same time, we're still concerned of risk management. We are unconcerned about what will happen next to protect our investments, right? So as an exchange, we develop for you products. We have futures products where you can take the opposite direction to short. But more importantly, the products that will benefit you, take a look into options, right? Into options, because options gives you the ability to take a view or to generate strategies at a cheaper cost than futures, because you just pay a premium and you can take a view of the of both sides of the markets. Let me give you a local example. For example, there is in Malaysia this year, I think we're due for an election. We're due for an election, and of course, when there's comes to the election, there always will be an uncertainty, right? We do not know whether the government will win, the government will lose, and evidently, by using options, you can actually take a view of both sides, right? Let me give you an example. In 2013, in Malaysia, people are uncertain whether the current government will actually win, right? At the same time, so if they were to trade the futures contract, they were to long, and the government loses, they will lose money. Yeah, they will go the other side, they also lose money. So what do? So they utilize our option contracts, right? Options on the Kuala Lumpur index. What happens is they buy a put and they buy a call. They generate a straddle, right? That enables them to make money in either way of how the market moves, right? So option contract gives you the ability to form such strategies, and as an investor, you should look at such instruments to consider when investing. Yeah.
Great. Thank you very much, Kenneth. Now we'll move on to our representative from Dubai.
Yeah. First of all, let me just touch on the success story. The success story is some of our participants use our contracts for hedging purposes, and it's quite prominent or quite important for them because, you know, when you're holding gold, for instance, you're up by 10%, but let's say your currency is down by 6%, then obviously the net return is only like roughly around 4%. So when we design product as the largest exchange in the Middle East, when we design products, we always look at from the underlying perspective and from the currency hedging perspective to cover both sides. Now, talking about the lack of information, I think our approach for lack of information is when we, you know, our market share in terms of market demographic, yeah, Middle East clients contribute, including Indian, contribute close to about 60% of our market share. And then 20%, the other 20% comes from Asia. And the other 20 would be from European side. So the approach that we saw and the observation that we had in interacting with different clients is that the Asian clients, particularly this part of the world, they will need a lot of hand-holding, a lot of care, a lot of information. Primarily is a catch-up game for participants that are less exposed to futures trading. If it's on the European side, you just give them the contract specification. You don't need to say anything. They will do their own analysis. But on the Asian side, we make it a point to call them, to, you know, to keep them updated at any possible changes and you know, go through the learning process with them. Yeah, that's how we overcome the lack of information for our clients. Yeah, thanks.
Great. Thank you very much, Mr. Meng from Dubai. Next, moving on to a representative from Telkom.
Yes, I think I'd like to point out to the case of the Nomura Securities. Nomura Securities is the largest securities company in Japan, and they are providing ETN contract, exchange traded notes contract. That's kind of an ETF contract, but ETF is backed by physical commodity. ETN is backed by the capital of the securities company, and Nomura is providing crude oil ETN. They have been doing this for many years. But when the price of crude oil went down around 2014, suddenly retail investors got involved in this ETN contract. They started to buy ETN contract, and it got really popular. And Nomura is using Tokom's market to hedge the exposure in ETN market, so which made the market also bigger. So three of us, you know, ETN is listed on Tokyo Stock Exchange. So TSE, Tokom, and Nomura Securities, as well as those who are involved in this market, all had a, you know, experienced a good result out of this Nomura's, you know, activity. So if there's a company in Thailand, I'm not really sure about the regulation here, but if there's a company that can do a similar thing as what Nomura done, then that might have a, you know, big impact on financial markets in Thailand overall.
Great. Thank you very much, Ms. Seki, for pointing out synergies that fund managers can deploy features with. Moving on to our representative from Korea, Mr. Lee, any stories you'd like to share?
Yes, thank you. And it's really still almost the final. And I'm sure everyone here is really familiar with the traditional investment strategy by asset management industry. So I'd like to discuss some interesting way to be discovered in Korea derivatives market. Although our main product is Kospi 200 futures and options, in 3 years and 10 years Korean Treasury bond is the highly volatile and liquid product with 100,000 contracts per day. As a result, we have noticed that many global asset managers are actively running into the what you call intermarket equity future, intermarket fixed income futures arbitrage. with JGB futures in Japan, or 3 years, 10 years, Australian government bond futures, since they are showing similar direction with our Korea Treasury bond futures. And I told you in the beginning, our single stock futures reached 1.5 million contracts per day, and a lot of experimental attempt is being made so far, such as with cost arbitrage or hedging between KOSPI 200 futures and options and ETF product, and they make a single stock futures basket. And it's a good way to avoid the short selling regulation. In the meantime, they can avoid stamp duty in the stock cash side. And there are more. I told you our KOSPI 200 options recording number 1 or number 2 in the worldwide in terms of transaction, with more than 50% of foreigners. That's already approved. They are successful story in Korea. So I'm telling you one more time, it's time to buy Korea. Again, it's a safety place. Thank you.
Thank you, Mr. Lee, for pointing out the opportunities in options as well. Last but not least, we have Mr. David Gibbs, who I'm sure you have a lot of stories you could share with us on how fund managers or sophisticated investors can employ some of the products in your markets.
I'm going to tackle this question. The two-pointed question was about information and then the success stories. I'm going to turn that on its head a little bit. I can't think of a part of the capital markets industry that is more transparent in terms of providing information in the futures industry. And I'm going to take a little liberty and speak for all of the other panelists here and say that as an industry group, we report our prices every day, transparently, publicly, and openly to the world at large. We represent the volumes that are traded on our products and the positions that are held open every single day. The contracts, the standardized futures contract is available for anybody to view from the internet, from all of our websites. So in terms of being able to determine information about our products, again, I don't know what it is that the questionnaires are looking for, but I would suggest to you, you're not going to find, in terms of the investment world, a more open and transparent industry than the futures business. Our whole function is to provide information and intelligence on our products. So if that's kind of switching that question and turning it around, I think that's something that needs to be said. In terms of market success, I'm going to take kind of a contrarian view on that. Rather than talking about how our products and services can be used, I'd rather look and would ask the audience to consider how our industry provides risk management functions for the world as a whole, and particularly in economic and financial markets in general. When we weathered the economic storm of 2007 and 2008, the traditional OTC capital market structure absolutely went upside down. There was a dearth of liquidity. There was flights of private companies into the hands of central banks for security, and the public was terrified that there was going to be a huge global depression. The one industry that came through that without a whiff of scandal and at no point closed its doors was the futures industry. We've provided historically risk management principles and tenets that provide security, safety, and objectivity. And I think the greatest story, when we subsequently set record-setting trading and open interest records, particularly in the most recent general election in the United States, where we did 3.5 times our average daily trading volume in one 24-hour period, was the stories that you did not hear. There were no out trades, there were no mispriced trades, and there was no failure of the system to provide liquidity or post-trade risk management functions. So I think the real story from the futures industry is when you don't hear about us. And I would suggest that the real testament of a true risk-providing structure is how infrequently you hear about their problems. And in that sense, the futures industry, I think, rises to the top in this respect. Our functions are not to create or products that generate risk. It's to mitigate the risk that exists within the global commodity and financial markets in general. We do this by paying attention to what our job is, and that's to provide products and services that answer both the requirements of people who are trying to sell risk and those that are willing to buy it, and giving them equal and a neutral access to a marketplace for price discovery and for risk transfer, and then in the post-trade open position environment, manage the risk that exists so that the system in general can operate healthy and on an ongoing basis for everyone, private and public also.
Thank you very much, David. I think I speak for all of us, and that's a great summary on why we should consider international futures as well. Also, to answer everyone's concerns on those two very valid reasons, is that at the back of the room, all our experts are ready. If you have any questions, please approach one of our experts, and we will try our best to answer it. If we cannot answer it, our commitment to you is that we will work with our partners here on stage to answer any questions you may have, whether it's lack of information, ways which you could manage your risks, etc. So we're happy to partner with you in discovering global futures. Now, to recap, Phillip Securities is very happy to have benefited from this discussion. And as a gesture of our thank you, we'd like to invite Mr. Lau Si Keong up on stage to give a token of appreciation to our partner panelists up here.